If you invested $100,000 into an index fund today, which one would actually grow your money more, Fidelity or Vanguard? That's the $1.5 million question we're looking into today. In this video, I'm going to show you and John exactly what happens when you put $100,000 into Fidelity's index funds versus Vanguard's. We'll be looking at real numbers, performance, dividends, fees, and how those all compound over time. Both providers offer index funds in the same categories, which makes the matchup fair. We'll compare their fees, S&P 500 funds, total market funds, balanced stock and bond portfolios, and finally, emerging markets. And at the end, you'll see which one across the 5 categories could leave you with more than $1.8 million extra in your portfolio. But before we jump into the battles, let's quickly clear up what an index fund actually is, because that's the foundation of everything we're about to see. An index fund is basically a basket of stocks. Instead of picking individual companies and hoping you got it right, you invest in a wide range of companies all at once, so your risk is spread out. Most index funds follow specific benchmarks, like the S&P 500, and try to match its performance. Because these funds don't need a team of managers constantly buying and selling stocks, the costs stay super low. You just set it, leave it, and let time do the heavy lifting. In fact, many financial legends, including Warren Buffett, recommend index funds for everyday investors who just want consistent, solid returns. So the strategy makes sense, but the real question is, who delivers better? Is it Fidelity or is it Vanguard? Before we compare the actual funds, we need to talk about the companies behind them, because their values and philosophies have shaped how their index funds perform, how much they cost, and even how they're managed. Let's start with Fidelity. Fidelity is one of the oldest and most well-known investment firms in the U.S. It was founded all the way back in 1946 by Edward C. Johnson II. At the time, the idea of actively managing investments to spot big winners was still gaining ground, and Fidelity leaned hard into it. In the 1950s, they became known for identifying growth companies early, like Xerox and Polaroid, and building wealth through smart stock picking. Fast forward to today, and Fidelity now manages over $16 trillion in assets and serves more than 50 million investors. They offer a wide range of services, from retirement accounts to trading platforms, and they've kept pace with modern investing tools, including sleek mobile apps and commission-free trading. One thing Fidelity is known for? Innovation. They've always been willing to adapt quickly and compete aggressively on fees and features. Whether you're an active trader or a passive investor, they give you options. Now let's talk about Vanguard, the giant that completely changed the investing world. Vanguard was founded in 1975 by John Bogle, and he came at investing from a very different angle. While most firms focused on beating the market, Bogle believed that just matching the market could be even more powerful if done with low fees and a long-term mindset. He introduced the world's first index fund in 1976, a fund that didn't try to beat the market, just mirror it. People laughed at him then, but we all know now he was right. Vanguard is still known as the king of low-cost investing. Why? Because it's actually owned by its investors, not outside shareholders. That means profits go back into lowering fees, not into executive bonuses or dividends for Wall Street. That's why so many long-term investors swear by Vanguard. It's built for people who want their money to grow quietly but strongly over time. So while Fidelity is more traditional and fast-moving, Vanguard is all about long-term simplicity and giving power back to the investor. But which one helps you keep more of your returns? Let's see how the fees stack up, because even a small difference in costs can make a big impact on your returns. Even though index funds are known for being low cost, there are still differences between providers, and over time, those small differences can really add up. If you're investing for 20 or 30 years, even a 0.01% difference in annual costs can snowball into thousands of dollars lost. Let's start with the basics. Both Fidelity and Vanguard offer commission-free trading for stocks, ETFs, and most mutual funds. That's great news. It means you won't pay a fee just for buying or selling your fund. But there are still management fees or expense ratios, which reflect the percentage of your investment that goes toward operating the fund. This is where things start to separate. Fidelity is known for pushing fees as low as possible. In fact, they shocked the market by offering some funds with zero expense ratios. One of their most popular, FXAIX, their S&P 500 index fund, has an expense ratio of just 0.02%. That's impressively low. Vanguard's VFIAX S&P 500 index fund is also one of the cheapest funds on the market at 0.04%, but still slightly more expensive. While it's a difference of just a few bucks on a $100,000 investment, $15 versus $40, the longer you invest, the more it matters. Multiply that by years, compounding growth in portfolio size, and the savings stack up. Then there are the account-level fees. Vanguard charges a $25 annual fee on brokerage and IRA accounts unless you opt into paperless statements or have over $5 million invested. Fidelity? Absolutely no account fees, not even for IRAs or smaller balances. And when it comes to trading extras like options and bonds, Fidelity comes out cheaper again. Vanguard charges $1 per options contract, while Fidelity charges 65 cents. Both firms charge $1 per bond for secondary market trades, but compared to Vanguard's $25, Fidelity adds a $19.95 broker-assisted fee. So when it comes to costs alone, Fidelity wins this round. Their rock-bottom fund expenses, no account maintenance charges, and lower trading fees make them ideal for fee-conscious investors who want to maximize every dollar. So now that we've got the fees out of the way, let's see what really matters, how much each fund can actually grow your money, starting with the benchmark S&P 500. This index tracks 500 of the largest and most profitable U.S. companies, including names you definitely know: Apple, Amazon, Microsoft, Google, and more. If you want a simple set-it-and-forget-it way to invest in America's biggest businesses, this is it. Historically, the S&P 500 has delivered about 10% average annual returns, and over the past 15 years, that number has climbed even higher, up to 12.6% per year. That's a strong track record. Both Fidelity and Vanguard offer extremely low-cost funds that follow this exact index. For Fidelity, it's FXAIX, or the Fidelity 500 Index Fund. For Vanguard, it's VFIAX, or the Vanguard 500 Index Fund Admiral Shares. Both funds are built to mirror the same set of companies, and on the surface, they seem nearly identical. But once we dig into the actual results, small differences begin to show. So how do I compare them? I put them in my forecaster calculator, which uses these metrics from funds to tell me how much I should expect from a fund. $100,000 investment, dividend yield, average annual return, dividend CAGR. Let's look at the key metrics that drive their performance. Fidelity's FXAIX has a forward dividend yield of about 1.16%, with dividend growth around 7.01%, and annual share price appreciation averaging 13.04%. Vanguard's VFIAX matches the same dividend yield at 1.16%, but its dividend growth is slightly lower at 5.8%, while share price appreciation comes in a little higher at 13.21%. Now, what happens when John invests $100,000 and just lets it sit? Fidelity's FXAIX adds a total value of about $4,462,935, including stock growth and reinvested dividends. Vanguard's VFIAX ends up close, but slightly higher at $4,582,491. That roughly $119,000 gap may not seem like a deal breaker in the long run, but it matters. Even small efficiencies add up when you're talking about six-figure investments over decades. So in this round, Vanguard takes the win, tying up our scoreboard at 1 apiece. But the S&P 500 isn't the whole story. What if you want exposure to everything in the U.S. market, from large caps to small startups? In the end, I'll show you which one across the 5 categories could leave you with more than $1.8 million extra in your portfolio. Let's find out who performs better in that next round, the Total Market Index Showdown. This type of fund isn't just about the 500 biggest companies. It's designed to include thousands of U.S. companies, from the giants like Apple and Tesla to smaller and mid-sized firms with high growth potential. It gives you the full picture of the U.S. economy in one investment. Think of it like zooming out to see the entire landscape, not just the skyline. Fidelity and Vanguard both offer top-tier total market index funds. Fidelity's version is FSKAX, the Fidelity Total Market Index Fund. Vanguard offers VTSAX, the Vanguard Total Stock Market Index Fund Admiral Shares. Both track a broad U.S. market index and include around 3,500 to 4,000 publicly traded companies covering nearly the entire investable stock market. Here's how they compare on the numbers. Fidelity's FSKAX has a forward dividend yield of about 0.99%, with dividend growth around 5.35% and annual share price appreciation of about 12.05%. Vanguard's FTSAX comes in slightly stronger on yield at 1.16%, dividend growth around 5.82%, and 12.22% average share price appreciation. So how do they stack up when we put $100,000 into each? Let's start with Vanguard's FTSAX. Over 30 years, it would add a total value of $3,551,112 to your $100,000 investment. An impressive figure that includes capital appreciation and reinvested dividends. Fidelity's FSKAX would come in a little lower, with a total value of $3,306,803. That's a solid return too, but still about $245,000 less than Vanguard's performance over the same period. It's worth noting that their holdings are nearly identical. Both funds include the same major companies and follow similar allocation strategies. So what's driving the gap? It likely comes down to slight variations in fund structure, dividend reinvestment timing, and tracking precision. Vanguard's long-term indexing focus seems to have given it the edge here. So this round also goes to Vanguard, which brings the scoreboard to Fidelity 1, Vanguard 2. Let's see if Fidelity can tie up the score as we head into the balanced fund comparison, where stocks and bonds team up in one portfolio. Not every investor wants to go all in on stocks. If you're looking for a more balanced approach, one that mixes stocks for growth with bonds for stability, then balanced index funds might be exactly what you need. Balanced funds offer a best-of-both-worlds approach. The stock portion gives your portfolio room to grow, while the bond allocation helps smooth out the ride during market downturns. It's a great strategy for investors who want steady growth without taking on full equity market risk. Both Vanguard and Fidelity offer solid contenders in this space. For Vanguard, the go-to option is VBIAX, the Vanguard Balanced Index Fund Admiral Shares. It maintains a fairly straightforward allocation, about 60% in U.S. stocks and 40% in bonds. The idea here is balance and simplicity, a fund you can hold for decades with confidence. Fidelity answers back with FBALX, the Fidelity Balanced Fund. This one has a similar stock-bond mix, but takes a slightly different approach. Unlike Vanguard's pure indexing strategy, FBALX uses active management to select specific securities. That means fund managers can make moves based on market conditions. Now, before we look at the results, let's check out the metrics that drive their performance. Vanguard's VBIAX has a forward dividend yield of about 6.5%, dividend growth of 6.05%, and share price appreciation of around 6.2%. Fidelity's FBALX comes in with a forward dividend yield of 5.32%, dividend growth of 4.14%, and the same 6.2% share price appreciation. On paper, Vanguard already looks a bit stronger, but how does that actually play out with John's $100,000? Here's the difference. Over 30 years, Vanguard's VBIAX adds about $3,380,059 to John's initial $100,000 investment. It also pays over $16,000 in dividend income by that time. Meanwhile, Fidelity's FBALX ends up much lower, at about $1,740,570. That's nearly a $1.64 million gap, which is huge, especially for a fund that's supposed to reduce risk, not eat at your returns. And compared to Vanguard's $16,000 monthly dividends, Fidelity only pays around $4,000 in monthly dividends. The likely reason? Vanguard's indexing strategy has lower fees, fewer surprises, and lets compound growth do the heavy lifting without interruptions. Fidelity's active approach adds more costs and more human decisions, which often hurts long-term performance. So this round goes solidly to Vanguard, pushing the scoreboard to Fidelity 1, Vanguard 3. Let's see who takes the lead in our next round as we head into the high volatility, high reward zone of emerging markets. Emerging markets are countries experiencing rapid economic growth and industrialization, like China, India, Brazil, and South Africa. Investing here means higher volatility, but also the potential for strong returns over time. Both Vanguard and Fidelity offer funds targeting this space. Vanguard's pick is VEMAX, the Vanguard Emerging Markets Stock Index Fund Admiral Shares. Fidelity counters with FPADX, the Fidelity Emerging Markets Index Fund. Vanguard's VEMAX has a forward dividend yield of about 2.22%, dividend growth of around 6.25%, and average share price appreciation of 4.63%. Fidelity's FPADX is a touch stronger across the board, with a dividend yield of 2.32%, dividend growth of 7.18%, and share price appreciation of 4.98%. So what happens when John drops $100,000 into each? Vanguard's VEMAX adds about $765,535 over the long term. Fidelity's FPADX does a better job here, finishing at about $968,349. That's a difference of more than $200,000 in Fidelity's favor. The difference may come down to slightly better fund structure, fee optimization, or timing of reinvestments, but in the end, FPADX wins the emerging markets round. That bumps the scoreboard to Fidelity 2, Vanguard 3. After 5 rounds, here's where we stand. Fidelity wins on fees and in emerging markets. Vanguard takes the crown in the S&P 500, the total market, and the balanced fund battle. That makes the scoreboard Fidelity 2, Vanguard 3. But the real story comes from the numbers themselves. Let's break it down. In the S&P 500, Vanguard outperformed Fidelity by about $119,556 over 30 years. In the total market showdown, Vanguard beat Fidelity by another $244,309. And in the balanced fund battle, Vanguard crushed Fidelity with a gap of nearly $1.64 million. Fidelity did fight back in emerging markets, with FPADX finishing about $202,814 ahead of Vanguard's VEMAX. And of course, in the fee comparison, Fidelity saves you a bit more each year, which adds up over decades, but not nearly enough to offset Vanguard's dominance in the core funds. So when you add it all together, Vanguard leaves you with about $2,003,354 more across its 3 wins. Subtract Fidelity's $202,814 advantage in emerging markets, and Vanguard still comes out ahead by roughly $1.8 million overall. And that's why the final winner here is Vanguard. If you're a long-term investor looking for the strongest overall outcome, Vanguard index funds give you more value where it counts most. Fidelity is still an excellent option, especially if you care about shaving off fees or wanting stronger emerging market exposure, but the heavyweight winner in this matchup is Vanguard. Not everyone has $100,000 to start with, but we have a solution for this. Click the video on the screen to find out how to make $7,000 per month with only $20 a week.